Global stock markets rise, U.S. exchanges close, traders wait for earnings report. Global stocks rose as U.S. futures were steady Monday, as investors focused on upcoming corporate earnings and rising interest rates as U.S. exchanges were shut in observance of the Martin Luther King Jr. holiday. In Asia, the Nikkei 225 Nik, plus 0.74% rose 0.7% in Tokyo, while the Hang Seng HSI, minus 0.68% retreated, with little movement generated by the People's Bank of China decision to cut interest rates on its one-year facility by 10 basis points. The Stoxx Europe 600 SXXP, plus 0.63% rose 0.6% in afternoon action. In morning action, the SPTSX 60 SPTSE, plus 0.32% gained 0.3% in Toronto. U.S. stock futures ES00, minus 0.05%, were little changed in electronic action, following 2 weeks in which the SP 500 SPX, plus 0.08%, has retreated by 2%. The tech-heavy Nasdaq Composite Comp, plus 0.59%, has dropped 5% this year. Historically, the start of the year has been a poor indicator of what is to come for investment markets, said Stuart Kirk, Global Head of Research and Responsible Investments at HSBC Asset Management. Since the global financial crisis, the average MSCI World return to the end of the year following a negative first 7 trading days has been nearly 11%, edging out the index performance after a positive first 7 trading days, he notes. Corporate earnings are due from the banking sector, with Bank of America BAC, minus 1.74% and Morgan Stanley MS, minus 3.58% set to release results, as well as more airlines and streaming giant Netflix and FLX, plus 1.25% expected to report results. UK stocks have outperformed their US counterparts as investors rotate into value sectors, with bond yields on the rise. We believe this move has further to run over coming months. The UK still looks excessively cheap, with a price/earnings ratio some 30% lower than the rest of the world, and the US excessively expensive with a valuation premium as high as 50%, said Rupert Thompson, Chief Investment Officer at UK wealth management firm Kingswood.